All right, everyone. I want to welcome you here to one of our first webinars here. We're going to be doing here a series of them. And I'm Michael Sabo. I'm with RJO Futures. I'm a senior market strategist. I've been with RJO since 2011. I had the pleasure of meeting Jeff Kazin, one of the principals of Agris Academy over 15 years ago when he became a client of mine, and I've known him ever since. And I'm kick it over to Mike and Jeff, and they can introduce themselves, and we'll get started here with the presentation.
Sure, go ahead, jump the slide, one slide.
Yeah, before we start, big thanks to RJO and StoneX for putting this on. This is a great format, and we're very excited to get this out.
Yeah, good evening, everyone. Thanks for dropping in. So a little bit about myself first, and Mike, and then we'll talk a little about Agris Academy and what makes it different. So my name is Jeff Kazin. I'm a 30-year veteran of the commercial industry. Worked all those years with Cargill all over the world. And I also farm at some scale in both Ohio and Minnesota. And that's actually how I got to meet Mike and the Chicago team. As I said, at least 15 years ago, starting to feel old, but not too long after we started farming. So it must have been 09, 10, something like that. And so my background is that 30 years of trading all kinds of things all over the world, from wheat to fish meal to lysine, and running spec and hedge desks for Inc. And we started Agris Academy about 3 years ago. Mike, you want to introduce yourself?
Yeah, Mike Rolfson. I also spent the bulk of my career at Cargill, and a lot like Jeff, trading a broad array of commodities here and abroad. A little difference in the last 10 or so years where I ventured away from Cargill and went a little bit more into the ag tech venture capital space. But yeah, 3 years ago, we kicked this off, and it's been extremely rewarding experience.
So what makes Agris Academy very different isn't maybe what we do, but it's what we don't do. We aren't an advisor. We don't broker. We're not an IB. What we realized, or what I realized through a journey of my own around agronomy, was nobody was really teaching merchandising skills to farmers. And, there's a lot of education efforts going on now outside kind of maybe the traditional routes of education in the farm community these days, lots of peer groups, things like that. And we just decided we're going to focus on educating in teachers farming merchandising and all the little details around thinking like a merchant. And then on the futures side, we really got down into what are the best practices of people that are actually out there being risk managers for things like crush plants and ethanol plants and feed mills. What are the best practices? And we kicked this off 3 years ago. We took a very handful of clients in the first year, and then we realized, we need to broaden that out. We started doing a winter class, which we'll talk about a little bit more, and some other ways to get connected with more and more farmers. But we found that those skills just were never available to the farm community in the U.S., Canada, abroad, and it became a very valuable source of education. It just keeps paying back on and on. And we really get down into the details when we work with clients, but it's all about winning on all these little steps and details in the thinking like a merchant. This starts to add value at the farm gate. We also have a commercial practice. We work with some end users, particularly maybe newer, or they want to go in and audit their end use systems to give them that sense of what we think is best practice and where they might need to pull in some more controls for their control environment, or what type of talent or skills they might need to run as a consumer. So that is us in a nutshell. And like I said, we've been at it for 3 years, and as Mike says, it's been super rewarding.
Yeah, it's very rewarding, and our genesis really was understanding, if you look at that pie of value between the buy and the sell side, too much slips to the buy side and away from the producer, simply because they're versed in these merchant skills and the producers are not. So that's our real mission in life, to level that playing field.
Okay.
Go to the next one. So we'll quick highlight of the agenda, and then we'll drill down into these. And the real spirit of this one is to, quickly but as thoroughly as possible in the hour that we have here, is to go through what we describe as sort of our top clients and or students that follow these best practices day in and day out, and how it's fundamentally changed the way they market their grain. And the first one is acknowledging that the efficient futures market reality. It's a wonderful tool, but it's also a very unwieldy beast, and there's a way to mentally change the way you do that, and utilize best practices to use it as a hedging tool. Separating futures and basis in your marketing plan, and in your interaction with your buyers, knowing risk is absolutely fun. And sorry, knowing your total position is absolutely fundamental to managing risk. Knowing down to the nth detail your cost of carry. Surprisingly, a lot of producers either don't know it exactly or don't know all the details and other additions that go into your cost of carry. And then using market structure to inform your physical grain movement. One of the teasers I'll throw out, if you work with us over time, is a fair amount of your marketing decisions become rather automatic due to the market structure that's in front of you at the time. It tends to make the decision for you when you're versed like a merchant. And we'll touch upon a little bit of that tonight, and head on to the next slide.
So before we get too far into it, if you have questions, please drop them in the chat. You should be able to see those at the bottom. If you're watching, you just kind of scroll down towards the bottom, click on the chat, and we'll see those. They come up on our right-hand side. We'll try to answer questions as we go. Please do put them in there. It makes for a richer conversation amongst everybody. Mike and I taught a college class this morning, and they were very good about asking questions as we went, which we weren't sure. We weren't sure they were awake at the time, but
they were surprisingly interactive. It was refreshing.
So the markets we're going to talk about, and obviously, if you're on this call, we're talking about the hedged markets today, but all the things we work on actually apply to everything from peanuts, dry beans, alfalfa. They just don't have a hedge or a futures market for the most of them. But we're talking about the big ones: corn, soybeans, wheat, cotton, things that are traded out on the CME. It's a highly efficient, highly regulated market. And what we know, because we traded it, right? When Mike and I were working in the industry, we had millions of dollars, hundreds of people all over the world at your disposal, anywhere from PhD quant math to, some very, very good weather meteorologists on your team. And people
agronomists spread around the world, field agronomists.
That's right. Feeding chickens in China or Guatemala, or fish in Norway, or smashing, soybeans in Brazil or Argentina, right? A huge amount of information. And we, over time, particularly over my career, watched that physical advantage get depleted. You think about what you have today, as far as information on your phone, right? When we started, NDVI information was top secret, and how they were using that to, now you get that free. It cost millions when I started to get that type of information. So what we have here in the world of the hyper efficient markets and the well-regulated markets that we actually, Mike and I'll tell you, we enjoy, at the close of the market at that moment in time, it's a 50-50 bet. It's the summation of all the players and all their opinions in that futures market. And we're going to go pretty fast here, but if you ever wanted to take a dip into the futures market or into the options market, and bring up some options, and you look at the money option, the put and the call trade for about the same price. And if the market thought, and remember, there's thousands and thousands of players here, and to figure this out is worth big money, that the market was skewed in some way, that this curve had a skew to it, price insurance, if you want to think on an option, wouldn't be the same for the exact distance away from at the money. And we see that in these efficient markets. We have people chart them. Very rarely do they show much skew at all in this curve. It's very, very, that market just is always moving to that center point. And if you look at this graph and you just let's just pick corn, let's pick December corn, there's a few people out there on the tails. If the y-axis is the number of people or the amount of opinion, and x-axis is price. On the right-hand side, right, there's just a few people that think corn should be $6. And then there's also, if you go to the left-hand side, right, there's a few people that think it should be $3.50. And there's relatively few, right? Most people, most bets, most probability is that that market's going to be right where we closed at that moment in time. And we have challenged that, and it's a huge portion of thinking to, we call it the wisdom of crowds. You're basically collecting all the wisdom of all the players all over the world that use the CME's markets for all kinds of different uses, comes out in the price. We'll go flip to the next slide.
So futures are an equalizer in a way. I know we sometimes curse their current absolute values, but at the end of the day, they are a amazing reference point for the U.S. Producer. And the reality of this, it's also a forward discounting mechanism. So a lot of times, the information you see in the moment has already been discounted um, quite a bit ahead of time before it actually reaches the public. And as Jeff mentioned, there are a long list of very well-heeled participants spending millions of dollars and throwing thousands of people at this to try to gain some sort of advantage in that price direction. And we say this a lot, if advisors and newsletters, could consistently beat the market, you wouldn't need farmer clients. Again, Jeff and I, as Jeff already mentioned, have been humbled many, many, many times by the futures market, though we won in the physical. And that's why we teach the best practice in the hedging side of futures, and perhaps not trying to beat yourself up and actually trying to beat it. And what you wouldn't want is a well-regulated futures market, because that's when the traders of the world like Jeff and I and large commercial entities would take significant advantage of you by taking that price transparency away. So
I think Mike meant to say absence of a well-regulated market.
yeah, the
right?
absence. Yeah, that's what I meant to say. Yeah. So you want that answer, as Jeff said, at 1:15 every day for the whole world to see, because the world's coming to the CME to price that grain, and it's definitely a gift of transparency to the U.S. producer.
In my 30-year career, the most money I ever made on a trade or a position was actually in fish oil.
Yeah.
Not wheat, not corn, not soybean meal, but fish oil.
Scrap metal in Ukraine.
Right. No transparency. We're the largest feeder of salmon in the world, and fish oil is tasty magic in a salmon pellet or extrusion. When we start buying, we can move the market ourselves, right? That's what commercials like. That's where the money is made, where there is no transparency. But when you have a really well-run futures market that tries to equalize there's no inherent advantage between the bull or the bear, you get a lot of information flowing, basically pours in to try to figure it out. It's a huge advantage that the U.S. farmer enjoys, even though they curse it. I always say the last thing you ever want is Mike and Jeff to drop into your market without any futures markets, without any government reports, any way to add transparency, because we're going to use that giant network. If you have that commercial, war chest behind you, and we're going to take advantage of it. That's our job. And that's what we did. I can, look at fish oil, fish meal, cottonseed oil, all just tremendous single time trades, because there just wasn't a lot of transparency. And so these futures are often an equalizer, and it's just not only the CME markets. There are other markets around the world that do a good job to bring that transparency and bring those various consumers that need price risk management out to the futures market. Next slide. Go ahead, Mike.
Yeah, so futures are, we'll definitely use this mantra a lot, that there are risks to be managed. It's a price discovery function, and like we said, they really function as a global price dial where the world comes to CME to price that. Lots of decisions going into this, thousands of big resource players. As Jeff sort of prefaced in the prior slide discussion, when people often ask us, what do we think futures will do? We sometimes give the rather obtuse answer, but what did we close at today? That's what the world's voting at for today's price. And a lot of times people will throw out the idea of something's mispriced or the market's wrong. We had a famous saying on the desk in Cargill, if the market's wrong, it doesn't pay to be right. So you can stubbornly believe otherwise, but there's a lot of people putting those inputs to synthesize that price point at any one time. And the real takeaway on this slide is at the bottom, and it's this is something we absolutely drive home in our initial interactions in our teaching and our one-on-one client work is the moment you treat futures as a risk to be managed instead of a speculation vehicle, your approach will change. Your head will clear out a little bit, and it's a critical step, but it's often very difficult for a lot of folks. And again, we don't want to say speculation is necessarily bad. We don't teach it, we don't advise in it, we don't necessarily promote it. We understand that every farm is different, every risk profile is different. But when we're for this discussion tonight and interacting with us, futures are a tool and a risk tool that you can manage within the realities of your operation because every operation is different.
Yeah, this is a huge jump. We've never had a farm in all the hundreds of farms now we've worked with it picks it up right away. It sounds easy when you're sitting here. We go through this in some detail in class, a lot more detail. It's just hard to get over that siren song that says, God, if I could just get 20 cents more a bushel on a 200 bushel farm average, it's $40 an acre, and we're profitable. And how do I get that? And to make that jump that says I need to carry the appropriate risk for the farm, because that's what we're going to ask. If you call me and say, what should I do? I'm going to ask, do you have the appropriate risk for your farm? And it's futures risk. Futures is a risk to be managed just like weather risk. It's very similar to weather risk on a farm. You're going to do things to manage your weather risk, right? You're going to grow different varieties that mature at different times, that pollinate at different times, different crops, different operational plans to hedge off weather risk. And making that jump is a huge jump. But that mindset change that now you're the risk manager for the farm completely changes the spectrum, right? In most businesses that you work with on the buy side of commodities, the speculative positions are not held locally anymore. They're held in very isolated places. Cargill was Geneva, most of it, very little left in the US. Even Bunge, I think, stopped. They're hedging, right? They're out there making margins. They're managing.
No spec desk in Bunge anymore, is my understanding.
So you get that thing. One of the comparisons we use is when you look at the players that have lasted long term in the ag sector in the U.S. long term, and whether that's feeding cattle or hogs or
flour milling or
elevating grain, right? They're hedgers. Right? The long-term players realized a long time ago that they're not going to outcall these futures markets and that they're going to edge and hedge. They're going to work to create margins. They're going to hedge those margins, and they're going to be operationally excellent. In the commodity side of being a producer, if you're growing commodity crops, that's where we land. Have the appropriate risk on for your farm. And that's the question everybody's like, well, what should I do? And I'm like, don't know. If I knew, we're headed to the islands, baby. Low taxes, beautiful weather. It's not going to happen. How much risk should you be carrying for this farm? And every farm, as Mike said, is different. It's one of the reasons we don't like blanket advisory statements, because those advisors, those blanket buy, sell things, they don't know anything about your individual risk profile. And that's super important, because a young kid starting out, who's leveraged to the hilt, they can't take as much risk as, the 80-year-old guy that we met out, in South Dakota that has 1,000 acres of Iowa dirt free and clear. He can take risks, right? It's a different set. So again, this is a big jump. It's one of our key first jumps, and we spend a lot of time going through the numbers of this. Start being the risk manager from the farm. Get yourself off the speculation. It helps you make better decisions. Mike calls it headspace.
Yeah, it clears your head for sure.
Clears your head. Next slide. Best practices and futures, I'll catch this one. Over time, hedging accounts, if it's really a hedging account, should not make money, right? If it's a 50-50 bet the day you hedge anything, some years you're going to be making margin calls, some years you're not, you're going to be sweeping equity in. It's there to reduce volatility. If you can, quote unquote, make money in your hedge account, you're a spec, and you should stop farming and start trading. Okay. And over some years you'll have good, we call it good years. We don't even call it, we're just like positive and negative hedging results. I'm not even sure I like that, because you're not really losing money. If you're hedging, there's a physical commodity on the other side. Know how different products increase or decrease risk. We get called in our most dire things we get involved in is when people got into options or were sold options product that they did not understand. They did not understand how they impacted or what they did. That's probably the worst case scenarios that we get into. A lot of times it's just we're taking off risk and adding risk back. We're selling really poor basis because somebody, by the way, likes to buy really poor basis, right? We get into some things. Do you really know what you're doing and how that impacts your futures risk? The last one, Mike said, we're not necessarily against speculating. We know the odds. I think I remember the guys there at RJ when they found out I decided to end my career at Cargill and go farm. He said, "Hey, let's have a spec account." And I'm like, "No, it's not going to happen. I had a hard enough time doing this and lost plenty of hair and gray. If you want to spec, have at it. I mean, there's all kinds of people that do it. And it's actually way better than going to Vegas, by the way. The odds are pretty damn good if you really want to know the truth. Go ahead and spec, but separate your spec account from your hedge account. And the biggest reason, and the big companies do this, the businesses, if you run a crush plant, that spec is held somewhere else, because the last thing you want to do is make a bunch of money in spec and think your business is fine and find out that your competitors have moved around you fundamentally, changed a process, gone to a different scale, all kinds of things, or vice versa. We used to see the other way. You got a whole big group right on your farm. There's 5 of you, working together. Somebody is specking and loses a bunch of money, right? And all of a sudden, whether it's the direct people that own it or your employees were on a bonus system, right? All of a sudden, there's no variable comp, or the farm's struggling, right, with paying the bills. We say, look, keep your spec over here. It's easy enough to do. It's another account, and have your hedging account there. It's a management best practice. Isolate your spec from your hedging and running your day-to-day business so you can make really good decisions for your day-to-day operation. If you're a commercial consumer and you're on the call, same thing goes. If you want to have some spec, you have it in a separate account. It has limits that are set to it. There's a best practice around that, but make sure that your business doesn't need speculation to survive, because that's a tough road. Next slide.
So we're heading into number 2 now, and that's separating futures and basis. Now, no matter what complex or otherwise marketing alternatives you have or like to participate in, if you look at your risk profile, it all boils down to your bucket of futures and your bucket of basis, and both have to be managed, communicated separately in your strategy and in your interaction with your buyers. Again, futures are a risk to be managed. Basis is really about learning and execution, reading your local market, developing a feel for that. And there are best practices to manage both basis and futures. And we'll get into this on the next slide. And go to the next slide. There we go.
Go ahead, Mike.
Yeah, so we talked about the one big picture level of price transparency in futures, but basis in essence provides a whole other drop down and localized level of that. And it's also a price discovery function. We talked about the global price dial as the CME futures, but the basis tends to function more as a local or regional price dial. As we sort of hinted at already, the commercials are largely, trading in basis and incentivized in what their basis P&L is. And your buyer, at the end of the day, a lot of people think maybe your buyer's specking on the side, or your buyer's company as a whole maybe is making certain has a certain profitability level depending upon futures. It really primarily boils down to basis. It functions as that local catalyst to move grain at times when you need them, and then maybe slow grain down when you don't. It's that local price dial, and it's also really another gift for the U.S. producer. If you look at a basis map, or there's a couple of different entities that put these out. It's a beautiful sort of mosaic of where that relative price value is to futures in various markets, various regions, that can be extremely informative to the producer. And the other part to this, when it gets down to the real art of managing both these buckets, is they don't really necessarily move together. And there's best practices to managing both and maximizing value from both separately. Next slide.
Best practices. So we're going to follow this up, and you can kind of see the rhythm here, right? We're going 1, 2, and 3. Now we're talking about a few of the best practices. If you haven't been using basis, we get a lot of farms that don't understand basis. I'd say probably 30 to 40% of the farms we interact don't really get involved in basis. You think about that, still gives you 70%, right, that do at least have a general, but start to get an understanding of what your local basis is over time. It does change over time. New plant gets built close by. We've had lots of that happen. Changes the way things work. Freight, changes over time. Barge freight obviously fluctuates wildly, even rail freight trades. You start to get a sense of what drives it. What are the big markets that pull grain from your area or consume it locally? Understanding kind of there is a local thing. You should never ask a buyer about their bid in a flat price sense. So buyers are always going to want to turn you to flat price. They like it when farmers talk flat price, because then they're not really negotiating around the basis. They oftentimes even have a better screen, right, that's updating faster if you're on 10-minute delay and they're not. And you go, well, gosh, is it really worth it? Well, if you're on a 5% elevation margin and you can skim out another 1 cent, it's a 20% increase, right? Still doing the same thing. We're not used to thinking about how tight those margins are in the grain handling, but they are very tight, and small pieces matter, right? And if it's a penny on your 200 bushel corn, it's $2 an acre, right? We're talking about stacking those pennies. So you should always ask, as this says right here, the only negotiation you should have on any time with a buyer in a hedged market is what's your basis. The whole negotiation needs to be about basis. And at the end of the conversation, we can talk about what we're going to do with the futures portion. Are we going to write a basis contract? Are we going to spot the board? Are we going to exchange futures? With my hedge account, there's lots of things we can do, but you really want to focus in on having that conversation on basis. When you talk to a grain buyer across the US and Canada, and you talk about basis, it sends a signal to that buyer that you're a reasonably sophisticated seller, which changes the conversation.
You'll be treated differently forever when you go with that approach.
Because now you're talking their terms. That's how they talk. When they have a discussion about selling corn to Tyson or Smithfield, there's never a conversation about futures.
20 years of my time, I'd never heard a flat price internally mentioned once.
And all basis, all the time, and they exchange futures. So now you're operating in their language. You show some sense of sophistication, understanding. It's a nice little jump. You haven't already went that way, but I don't care if you're negotiating, 2 spot trucks or 100,000 bushel lots. The conversation is just about basis. I don't want to talk, and we'll see it all the time. They'll try to reel the customer back into flat price, or they'll call them and say, "Hey, we got a hot special, $4.50 corn, for July, something like that. Well, when you look at the futures and the carry, 450 isn't that interesting. Now, if you had a conversation about basis, different conversation. We've seen that in the last week. So develop your feel for your own local market and bias and what happens, what the local supply and demand is. Are you going to have to draw grain in? Are you going to have to get it out of there? Lower futures prices tend to slow farmer movement, support basis. If you get a futures run like we had last Dec, Jan, Feb in corn, all the way to the $5 mark, basis tanked. We didn't really need that much corn in that moment, but the futures was moving, right? Because the futures is a global dial, and the basis is that local dial. You want to trade both of them separately, manage the risk separately, and maximize. Our best students in the Eastern U.S. hedged off some $5 corn, where that's probably in the May, and then they sat there and waited. I think they may even rolled to the July, and basis in Ohio got to 75 over. And so that's just, if you think about it at the time, just how important basis can be. Basis volatility in corn in Ohio was more than futures last year. We went from 60 under to 70 over. That's volatility. And if you know both, you're managing that risk well, you're hedging off your futures, you see too much grain moving, there's nice carries, you wait for that carry to come out, then you start pricing your basis. Those were the guys selling 550s, 575 corn last year. Not a lot of it. They didn't do it on every bushel. Let's be realistic. But understanding this piece of the basis picture, if you're in a hedged market, super important. Any questions? I know we've been zipping along here and haven't had anything come in the chat, but please, if you have a question, just type them into the chat, scroll to the bottom of the page, and you'll see the little chat button. Next slide.
This is a big one, and something that was very easy for us to understand, because in our former life, I don't care if the computers are down, I don't care if the printer's broken, I don't care if the power's out. You're going to know your position, and we underscored it's a non-negotiable to managing risk, and it's absolutely true, because you can't manage what you're not measuring. So it's incredibly hard to know. If you don't know where you are, you don't know what it is you need to manage. That said, when you do know your position, it clears your head. It decreases that time to make your decisions. You have data to leverage. You can utilize. It's incredibly important to know, as you know your position, especially as you enter harvest, around various operational metrics on your farm, space planning, which often drive each other mutually. You don't have a lot of surprises. You better understand all the alternatives that are out there relative to what you have to either bring to town, or what you're going to store, or whatever options are developing there in your localized market. Allows you, we have found with a lot of our A students, we give a tool, and we'll talk to that tool here in a little bit and offer it up to you folks if you want it. You can all sing off the same sheet that shows, where your production is, what that yield is, how that translates to space, and what needs to come to town. And maybe also you can go into the merchandising side in terms of what's already hedged, what needs to be hedged, where we are on basis, all that stuff, all in a very easy to read, concise document that demystifies a lot of things, and allows you to then focus your efforts on the go forward very specifically and very effectively. And again, this is not rocket science. We intentionally put that solar powered big button Casio calculator, because I literally still have mine from 1991. It's all beat to hell, but it still works. And we're not using cosine or anything. This is very much adding, subtracting, and dividing and multiplying. So next slide.
All right, so I think we'll just start this slide off. Mike and I have worked with a lot of farms, hundreds of farms now, through class, through workshops, through our retained agreements. We have yet to find one that knew their position. So if you're not doing this today, don't feel bad. There's a bunch of people that track unloads and maybe bin positions, but they're not they don't get everything. They don't get it in there right in these systems. Mike and I finally gave up. We had to develop our own tool for our students and clients. We've done that. We call it the Agris Risk Tracker. It's the same way, by the way, in commercial businesses. I regularly went into commercial business, even inside a company with as long a history as Inc. that didn't have their positions correct. It happens, right? When you're running 50 elevators, who's pricing what and when, right? How fast is it getting into the system? Those things happen. You might have some salesperson giving a free option to somebody, which gave you a delta you didn't know you had. There's things like that. So it happens. It takes a bit of time. It's not a lot of work, but knowing your position is operating from clarity, and clarity gives you headspace, right, to make good decisions. So a lot of the things on making good futures risk decisions for your farm are about clarity. And I can give you an example. We had a farm, we said, hey, what's your yield going to be? Let's get this updated in our trackers. And they go, well, it's going to be 185, which is a good yield for this region. And I'm like, really? So we went back, and
we had driven through there 3 or 4 times over the summer, and we're like, there's absolutely no way it's 185.
So, lo and behold, another person they assigned to go update these yields, another person in the team, and the yield estimate by field, came out at like 210. Well, that's a lot of bushels to find a place for, and a lot of bushels that weren't getting risk managed. We generally see on the ag production side a tendency to be conservative. That is systematic bias in your estimating, and that will cost you. A lot of them like, well, I want to be pleasantly surprised, or I don't want to be oversold. And we're like, I get it, but it's secretly sneaky costing you. You're not ready for the physical side and getting ready to do those things. You're not ready on the risk management side. You've got unrisked or unseen risk that you don't have out there. We see systematic bias to be conservative all the time, and it's always costly one way or another. Don't plug your APHs in. We know that's got all kinds of stuff in it, yield adjustments and things like that. And of course, you're investing in a crop differently each year. We also had a farm one time tell us that, can we just put in, the 8 county, one for each county that we farm in? I said, no, that's not going to be acceptable. More granularity is better. And as I kind of alluded to, you get a twofer here. You get your long effectively is what you're going to grow, what's out there. And we're actually yield estimating for 26 already because we start early. But as, of course, you're getting closer, right, you're making these operations plans and space plans and things like that help you maximize that basis piece of the puzzle and operations and some of these intersections. Separate your futures and basis. We talked a little bit about that. You've got 2 separate risks, and you got to be appropriate risk. But if you can't see them, you can't manage them. Input options contracts. Again, this is probably one of the places we see the most pain. People that don't know Delta don't understand what it means, that they're not actually 100% covered, that they ended up buying the risk back because somebody was selling puts underneath. We saw a lot of that, not this past year, but the 2 years prior. And kind of got to the point where if you don't understand just the basic concept of Delta, which is one of the few concepts we teach when we teach 4 nights on options for farmers in our class, we just say, don't do a lot of it. If you don't understand it real well, what Delta is and how it's actually managing your futures risk lower, then just don't be too big.
And if your buyer who's marketing to you, this product can't tell you the Delta either, that's usually a sign. So eyes wide open on this. It can fit okay in your portfolio as a whole, as Jeff said, in a reasonable amount. But yeah, a lot can get lost in what you're actually hedged if you're not Delta adjusting.
And the last one, stay current. Now I farm myself, right? How often do I open my tracker? Not very often, actually, right? The yields aren't moving a lot. My risk profile doesn't change day to day. That's fundamental to who I am and what my farming operation is. But if we make a trade, we'll run back through and update everything, update all the prices. We use principles like mark to market. on all commodities, both harvested and unharvested, things like that in our tracker. All the things you would expect if you were commercial and somebody came and said, hey, what's your position? And then use the data to inform your decisions. Don't kind of, right, sit down, clear that mind. Okay, this is my actual position. I feel good about this. I know my farms better than anybody. I don't have to tell anybody. And use that, be data driven. Again, it helps make good risk management decisions. And now we've graduated from speculator for the farm to risk manager for the farm. Very important position on the farm these days. And you also have to be able to communicate that. A lot of farms these days work together. It used to be two brothers finished, got out of, they also went off and started their own farms. Today, the two brothers and dad get together and farm together because that's how economies of scale are getting put together. Farms are figuring out how to cooperate, and we see it all the time. Usually somebody in that group is ahead of the risk management side, and being able to put data behind it and talk to the other people, the other constituents on that farm is super important. It also prevents back trading, because we all know we love a back trader. Why didn't you sell here? That happened to me all the time in Inc. Why didn't you get out of your position at the top every time? Well, right. So have data, and that also helps on the farm and the relationship. Next slide.
Oh, and an important point here at the bottom. We can get you our position spreadsheet if you want it. Reach out to us. We'll walk you through it. So, sorry. Next slide. So number 4, knowing your cost to carry grain. A lot of things go into this, and again, more often than not, we find folks that are either a little loose in the detail or really don't consider it at all. So your biggest cost to carry is the opportunity cost of your money, and another way of saying what's your rate of interest that you have to utilize for various financing activities. And it can come in different forms. You can have different forms of loans. You can have at different rates. But and by the way, if you're fortunate enough to not farm with the bank, there is still opportunity cost to your money. And you should be using a short-term treasury or CD rate of around 4% right now. I don't charge myself anything is not an acceptable answer. There is opportunity cost, and it's a pretty simple calculation to take the underlying cost of grain at your bin, remember at your bin, and multiply that times the interest rate divided by 12. You get your monthly cost in that. Shrink is a biological reality to grain. It can depend a little bit on crop year and maybe time of the year and that kind of thing. But commercially, at Cargill with the operational excellence they had, they used a standard 0.25% per month. And it's pretty darn easy to do that math and figure that out. There is a degree of variable cost depending upon your bin setup, depending upon the nature of the grain when you put it in there, how much you're drying, how much you're aerating, that kind of thing. It's not a big cost, but it's something to maybe consider, especially if you're carrying grain for a long time and really running the system to maintain condition. And there is, it's not really exactly related to carry grain, but it's a bit more in this last point, to carry or not to carry, is, a lot of times you have to, you're coming out of the field, you could go to town and be done with it and wrap the right marketing tool around it. But there is a cost to going back, running through your system, and then reassessing after that. So knowing what that cost is, and it can really vary depending upon, the nature of your bins. Sometimes it's a very low cost. Sometimes it can be kind of a pain in the butt and expensive and time consuming. So those are some of the main aspects that go into your cost to carry.
We could spend a long time talking about shrink. It does vary depending upon your facilities and how they're set up and what they're doing to that grain. Every facility is different. Our best producers have a yield monitor that is calibrated regularly. They have calibrated their grain carts, and they obviously are getting out. Some of them are weighing inbound and then outbound, depends upon, obviously not every farm has a scale at the site, but you can get final outbound weights, and they're watching shrink. It can be a pretty big factor, either from the facility or the management, and heaven forbid it's theft. But it's been caught. In Inc, several times we have caught theft because of shrink. where too much is disappearing for what the facility's history is. So it doesn't happen very often in the US, but every once in a while you'll get a wild story. We could talk all night about all kinds of ways we see shrink, and it can be a very important number. Obviously, as commodity prices have risen, the price of shrink goes up. And we saw that in spades, I think. When you look at storing soybeans in the US, and you've got operating notes right now like 7+% variable cost working capital notes. You throw in some shrink. If you have some commercial storage, or fundamentally whatever those storage costs, it gets hard to carry beans, which pushes more beans in the market. And 2 years ago, when interest rates started rising, I don't think the market was ready for how fast beans had to come in, and it really started to drive down basis.
It fundamentally changed the way grain moved that fall.
Changed the flows and the speed, because you really couldn't. If you're running an elevator and you're on a narrow, you're on a nickel margin, and you can't get a train for a month, your margin's gone, just in interest. So it really, as you get into commodities that are higher priced, it just gets hard to hold them. And that's how the world works, right, around that space. And generally, if you want to think about velocity and flows, watch the cost of the credit markets for farming. It'll tell you a lot about how fast grain is going to move, to a lesser degree, but the commercial one's a little bit more obvious, some premium to treasury. Okay, next, Todd. This was just a quick carrying cost example. We left one of these in. We had a bunch of them there. We were afraid we were going to go too long. And we just take a $10 bean, a 7.5% interest, and then divide by 12. So you're already in at 6.25 cents to store a bean at $10, at a $10 cash bean.
Just in interest.
Just in interest. If you're paying another 5 or 6 cents a month in commercial storage, right, you're 12 plus. If it's going home, right, you take that shrink, you got 2.5, you're at home, and you're shrinking that 20.25%, that's 2.5 cents just in shrink. Even at a existing fixed cost asset, you're over 8 cents, 9 cents a month. And that also, once you get that type of thing put together, you can look at that and go, well, what type of contract can I be in that starts to alleviate those things? What's the right decision? How do I think like a grain elevator? And those are the things we think. It says, well-managed farms understand that cost to carry in physical grain. When it doesn't carry, just like the elevator, they start moving grain. That doesn't mean they're unwinding their futures risk. That's a different bucket. There's lots of ways to carry futures risk that don't necessarily mean you have the physical grain. But what you don't want to do is keep eating the cost to carry the position be so high. And it's a classic mistake that we see. And once you really get good at it and getting the right contracts to the right type of market structure, I think Mike says it becomes a very automatic thing. Market looks like this, I do that. And I think that's going to be our last one. Next slide.
Next slide. So as Jeff said, there are moments in time when market structure informs what you do, and your decision is rather automatic. We talked about the carry, and understanding your cost to carry, and a lot of you probably on this call, or whoever watches this later in the recordings, they are either currently in or have just come off the widest carry of the year, the lowest basis in and around harvest, and then some sort of a carry out to January or March or April that is, as the widest sort of carry that you're currently seeing in your market. That said, when you know your cost to get there, that informs just to what degree you do that. Now that doesn't mean you necessarily have to lock in your carry, but you're at least eyes wide open and knowing what type of carry you do need to justify lugging grain through that time period and marketing it accordingly. And the other point we like to make is, these carries are theoretical until you are locked in with the two legs of the stool, that being futures and basis. So it's one thing to see it, it's one thing to think of it in your mind as to what that number is, but it's the final piece of actually executing it is when you lock in and have realized the price of that carry. The flip
Yeah.
side of this is, there are times when it does not pay to carry. I guarantee you there's going to be parts in the Eastern Corn Belt and this year, maybe Southern Corn Belt this year. And again, who knows what the market is at this time, but I'm pretty confident in those two places as examples. And basically anybody farming deep in the mid South or Southeast where you're going to be in an inverted market, meaning the market is begging you to market the grain now and giving you a price incentive, where the nearby price is here and the deferred price is down here. Managed farms recognize this. We beat this drum very hard in our teaching that thou shalt not carry grain through an inverse to any significant degree. And that was definitely something that was a carryover from our former commercial world, that the commercials and the buyers that you're dealing with when the markets get extremely inverted, their inventories basically go to zero. And they are moving grain into that inverse because it's not paying to carry. Going back to Jeff's point of, if you're elevating, 5, 6, 7 cents through your elevator and you miss that inverse as it slides down, all your margin just went poof. So, if they can do it, you can too.
Okay. Next slide. So in the carry or executing around carry, one of the things we've rough numbers, at least right now in the US, is you can kind of bank that you're going to see in the corn and bean world about 30 cents a bushel net. It can be wider or narrow depending upon the crop size and locale. But if you said you can earn 30 cents a bushel net of costs in the first 90 days, at 30 cents a bushel on 200 bushel corn, it's $60 an acre. On 1,000 acres, it's 60 grand. You have to be able to figure out, last year, that was the difference between making money and not making money in a lot of farms. Was I able to actually earn some type of carry? Now, obviously, we're not talking about specking in futures and how that looks. We're just talking about thinking of it as an elevator. So relatively, I don't say a low risk strategy, but you're running your business like the elevator. You can obviously spec as much as you want. Some years you're going to win, some years you're going to lose. Why does space get really valuable in the first 90 days? Because you got really only two choices. You either get the grain out of the field, right? Or don't. And so space is providing a place, you could leave it in the field. There was a joke out on social media today that, hey, my marketing strategy to capture and carry is just to be the last to be done harvesting. There'll be no line and the carry will be out of the market and life's good as long as a snowstorm doesn't come.
Or the deer
So you
don't eat
always
too
have
much.
that. Grain moves at harvest when it probably shouldn't, because you're either out of space or out of money. Both of those things can be worked on if you think about it and you have a plan. There's always these little pieces, right? And then you've got to actually look at earning that carry. How many farms we walked up and they got there's a bin full of grain. Oh, we're earning carry. Oh, really? Well, when did you set those hedges? There's no hedges. There's no basis lock. Well, you're not earning carry, at least if you haven't taken one of those legs off, particularly the futures leg of the piece of the puzzle a lot of times. Carry has to come out of the market to get commercial grain out of its shell once it's put away, and it does. And that's that first wave of once the crop gets put away, the carry has to get bid out of the market in order to get commercial grain to move. That's the second wave of grain after harvest. Sometimes, of course, it's hard to know when a market's actually at an inverse. We get a lot of lazy bids in today's world. People don't like to put their best numbers out there. They tend to stay relatively in the spot, and you have to have a bias kind of out away as to where you can lock in the basis. The futures obviously give you transparency, where I can know exactly where I can roll D's to March right now. I could go and do that D's to May. But you don't necessarily know what that basis is going to be. And a lot of times they have a lazy bid out there. We don't want people to carry grain through inverses. Sometimes you'll make your own inverse by saying, here, if you want my grain, this is what it's going to take to get it out of the bin basis wise. And then that gives the commercial something to react to. And our best ones are basically, you're in a carry right now, harvest is starting to wrap up in a lot of places. Where are your offers going to be? It says, okay, there's no more carry, and always have that offer available. And that's a great conversation and a great way to interact. Commercials don't carry grain through an inverse. Mike already said that. Actually, what they really like to do is short NPE, which is a whole another can of worms we do get into. No price established or delayed pricing contracts, one of my favorite things to do, and give you the risk. It's also very hard when you're a commercial. You can't get enough grain to fill an entire train. What do you do when you got a partial train? You got to have a certain amount of beans in front of a crush plant, the pipeline, but the market's inverted. And by the way, meal is inverted. So the Smithfields and the Tysons of the world are running their meal inventories way, way down. Everybody's going, shh, because tomorrow it's going to be cheaper than it was today. Yeah, you might be lucky and hang into it well into an inverse and get that big number, but net of interest, storage, shrink, and the probability the market collapses, it usually is not well advised. We used to say that death, taxes, and the collapse of the inverse all going to happen.
Are all inevitabilities.
That's right. So, okay, next slide.
We want to do a quick numeric example of carrying, executing in the carry. And going back to our example in slide 5, and there's really two, especially when you're separating futures and basis, this makes it easier. There's the basis carry, and again, we use sort of what was probably a relatively typical average sort of harvest low in beans, and then that carry to January. So in this specific example, if you take the minus 25 in October and the minus 15 in January, you have a basis carry of 10 cents. And let's say we had a theoretical, and again, it's bounced around since we've written this, but the November Jan was 18 cents. So you're talking a 28-cent carry versus your math on the cost to get there, and a net carry of 9.25 cents. So there's lots of different ways you can do this. You know, we threw out the ability to access our position tracker, but we'll also, if you want, we can get you our cost to carry worksheet too. It's pretty straightforward and makes it pretty easy for you to figure out what that is too. So just a little quick numeric example on ways to lock in or think about locking in carry. Next slide. And I think we are nearing, I think, the end of a lot of the content here. So again, any last questions, let us know. But lots of different ways to interact with us. Our website at agrusacademy.com. Our emails are right there. I just noticed there is a typo on my name. I wonder who wrote that. It wasn't me. Those darn Danes with the E and not the O. But yeah, you can find us also through info at agrusacademy.com. We're on Acres TV. Jeff especially has put in a tremendous amount of work to put in little snippets of merchandising wisdom on that. A very good and comprehensive way, especially if you're sitting in truck lines or running a grain cart right now, is to pop on the Farm for Profit podcast that was run September 22nd. It's about a 50-minute. You can, even shorter if you put it on 1.2 speed. It's a great comprehensive way for us to hear about us and all the things that we're about in one really well-run podcast. It's our third time with those guys, and we really like being on there.
I think there's one more slide.
One more slide, I think.
Right. So we are getting ready. We're in that time of season to start our master's class for the year. This will be our third year teaching the class. We're doing a little shameless plug. If you kind of interested, we caught some very high levels. We teach a serious class in the wintertime. It starts right after Thanksgiving, goes for a little while, take a nice Christmas, New Year's break. We come back and we finish hard January, February. It's a night class, live, 2 hours per session. So 40 hours total, so 10 weeks. 2 nights a week, and you get 40 hours. And then we've actually become very popular. We bring in some special guests for panels in the evening. We thought we'd all sit around and have a beer and talk ag afterward, but the crowd really wants to keep learning. And we've had people and very different ag bankers on. We brought some bagging people in that had actually done it or owned bagging companies. Bin control fan companies come and talk. And mind you, we're not taking any money from any of these companies. It's
Crop
related to our
insurance.
conversations in class. And so it's totally optional. Classes are recorded. It's very popular. We have a agreement with the Hefties to have a protected library out at that Acres TV platform where you can access the classes if you miss a class, and it also extends 4 or 6 weeks after class if you have to catch up. It's a ton of fun. It is going to be a very popular class this year. We can tell by our sign up rate, and we get really down into the details of some of the things we talked about today. And it is going to be a ton of fun. And it's a fully interactive class, even more so here, where we can see each other. We have office hours during the week where you sign up what times are convenient to you, and we actually put your farms into our risk tracker. We go through your own situations. Our best students use that extensively, so they get kind of that real hands-on experience in the meeting. So we're just getting ready to. I guess we'll keep signing them up here for another 3 weeks or so. Very affordable class. If you want to see the whole curriculum, preliminary, and actually sign up, you just go to agrisacademy.com. You can sign up right there. It's a fun class, and it's a really good way to get your knowledge level up, level the playing field, and it's a lifetime investment. And as Mike had alluded to, the way we structure it, the one tuition covers the farm. So because a lot of farms, it's multiple people involved in the farm, or it's the next generation. It's mom, dad, and daughter, mom, dad, and son taking the class together. And it's a ton of fun. And we're way up here in Minnesota. What better thing to do in the darkness of winter than get together and teach class a couple nights a week. Mike, you got anything else?
No, I think we covered it.
Excellent. Well, I want to take time to thank everyone for joining us this evening. Be sure to attend our upcoming classes that we're going to have. I want to extend a special thanks to Mike and Jeff with Agris Academy for joining us this evening, and hopefully you guys took away a lot. I know it was an hour kind of flew by. They've got a lot of information to share, so be sure, like I said, tune into the next few classes we're going to have in this series. And if you have interest in checking out their class, be sure to connect with them. We look forward to helping you guys out with this.
Great. Thanks, everyone.
Thanks, everyone. Be safe out there.